The cannabis sector is largely ignored by the financial analyst community, and that's because it's not understood very well, including by the few who do cover it. This author may have done some excellent work on other companies and other sectors, but it's unlikely that he knows anything about Tilray products at all. All his arguments are financial and mathematical. He writes, shares fell about 21% on the news in reaction to the new notes dilution to existing investors. While the conversion price is a fraction of our fair value estimate, the small size of the offering limits the dilutive impact. As such, we don't expect a material reduction to our fair value estimates of $6.50 and $9 Canadian per share. We believe the share price reaction creates even more upside opportunity in the only Canadian licensed producer under our coverage that's reached adjusted EBITDA profitability. So, to be frank, even the work on the financials is a little bit lazy. Because if you simply take their net revenue, subtract their cost of goods sold, subtract their basic operating expenses like general, administrative, selling, and marketing, you're already losing a fair bit of money. And then you take things like financing costs and impairments, and things are looking pretty bad. So how do they get their positive adjusted EBITDA anyway? Well, apparently things like amortization, stock-based compensation, and facility closure and exit costs are income. Now, as somebody who does understand their product, as somebody who has grown such products in the past, a long time ago, I'm not at all surprised by their financial performance. Because cannabis is more like wine than vodka. Quality really matters. And for the same reason, I was also unsurprised by who ate all their market share to quietly become the number 2 producer in all of Canada. And in so doing, grew their gross profit by 130%, and they've been profitable for 5 quarters now. So after that performance, I was surprised by the fact that I could only find 2 analysts covering Decibel Cannabis, and they only recommended them based on their financials, not based on the product quality, of course. But, due to the ignorance of the community at large, there is an opportunity to buy a high-growth company that's already making $20 million a year, has already given very strong guidance, and is valued at about $50 million.